episode of Woodburn's Solving Your China Business Pain Points. My name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. And today we are going to be talking about the importance of keeping a clean balance sheet in your China business. Balance sheets are a fundamental financial report on which a business can be evaluated. Though they tend to receive less attention than the financial statements that show profitability and performance, they are the preferred document by the Chinese tax authorities, who are basically interested in discovering any type of tax discrepancy or foul play. Taxes represent one of the most important sources of revenue for the Chinese government, and tax authorities have recently stepped up their efforts on enforcement and collection of all different types of corporate taxes: profits tax, VAT, consumption tax, stamp duty tax, etc. Even the most well-intentioned and honest businesses in China can get penalized for unqualified fapiaos, missing supporting documents, and ultimately basically simple human error, right, that can be made by outsourced accounting providers or in-house employees. Now, some poor quality accounting practices have been tolerated in the past, but really in the last few years, the strengthening of the tax compliance regulations has become one of the centerpieces in the economic reform taking place in China. Many companies have balance sheets that are not as clean as they should be, not because of any intentional oversight or effort, but because owners, leadership teams often don't know how to maintain a clean balance sheet. So unless GAAP, which is the generally accepted accounting principles, are followed properly, balance sheets can get distorted to the point where they no longer reflect an accurate image of the business's current financial position. SMEs often judge whether their balance sheet accurately reflects their businesses by examining figures and balances carefully. A clear balance sheet represents a clear picture of the company's assets and liabilities with no surprises or required adjustments. The more accurate and clear the balance sheet, the more credible your company's financials are. Adjusting balance sheet items that contain tax risks will often involve additional tax liability. Now, in China, in order to avoid a possible tax audit, business leaders, managers, accountants should learn how to identify tax risks by evaluating the contents of the company's balance sheet. You can start by checking your inventory balances. So if the amount of inventory goes up, but the sales revenue does not, this probably means that some products have been sold without recognizing revenue or issuing VAT fapiaos. This discrepancy alone, high inventory, low sales ratio, will probably push the tax authorities to want to visit your warehouse in case of a tax audit. At the same time, if the tax authorities estimate a theoretical revenue that turns out to be much higher than the revenue reported by a company, this may also indicate to them that the business is not reporting the real profits. And this is where we get also into the differential of reporting revenue based on fapiaos that have been issued or reporting revenue based on pro forma invoices being issued, and not knowing when that timing is going to be of when that invoice fapiao is going to then be issued. Now, with the golden tax system, tax authorities can estimate the revenue your business should report based on multiple data sources. And tax officers are automatically alerted if a business submits profits significantly lower than the estimated revenue within a certain period and time frame. Another situation that can be a sign that you might have used the VAT on the purchase of raw materials, so unsold products, to offset the output VAT on sold products, is when the inventory closing balance cannot be reconciled with your unused input VAT. Some of you may not know this, but when you establish your company in China, you're going to have to purchase a VAT software system from the Tax Bureau that is going to be tracking all of your input VAT, i.e. the VAT on purchases that are made, against the VAT on sold products or sold services. And if this cannot be reconciled, or you have underreported your VAT, postponed your profits tax liability, both of which are non-compliant issues under tax law in China, then a tax audit could arise. So these are all the things, and I could go on. I mean, the list goes on in terms of what could happen in terms of, not keeping a clean balance sheet. But as we want to make this a short daily video, it is just to explain that if you don't follow the right accounting principles, it could affect having a clean balance sheet. And ultimately, it's important to note that the tax officers are looking at your balance sheets more than they are looking at your P&Ls. So making sure that you have these clean balance sheets is of utmost importance. And if this is a point that you're struggling with, where you're not sure or you have this gut feeling that your financial management reports, balance sheet, P&L, maybe even your cash flow statement, trial balance are not in order, this is where you need to pick up your hand and talk to an expert about how they can resolve these issues, or at least do an internal audit to either say, yes, your gut feeling is correct, or no, actually, everything is kosher and above board. So if you do have this struggle, we've got the link to our diary. Set up a call with us and we'll see if we can be of any assistance to you. In the meantime, if you liked this video, please do press the like button or share it. This helps more people who do have a China business gain access to these videos. And our objective ultimately is to help those who do have business pain points solve them as quickly as possible. And if you want to learn more about what we do at Woodburn Accountants and Advisors, head on over to our website. It's www.woodburnglobal.com. Hope to see you at our next video. Take care.